Hey everyone, welcome back to the channel. So here's the thing, what if I told you that Nvidia, the tech giant that's practically printing money in the AI boom, just quietly made two huge moves in the stock market? Yeah, you heard that right. While everyone was distracted by their massive sell-offs last quarter, Nvidia slipped under the radar and invested in two brand new AI companies. Now before we dive into those two stocks, let me give you some context. Nvidia has been on an absolute tear over the past few years. Their GPUs have become the backbone of AI development worldwide. And as they've grown larger and more profitable, they've started investing heavily in other AI companies. In fact, up until last quarter, Nvidia had been ramping up its stock investments nearly every quarter, doubling down each time to the tune of almost $500 million. But then something interesting happened in Q4. According to the SEC filings, which were just released, Nvidia actually cut down their total investments to around $300 million. That means they sold off a ton of positions during the quarter. And don't get me wrong, that's a big deal. They exited several AI stocks that were once part of their portfolio. I'll be making a separate video covering all of those sell-offs because some of them were pretty popular AI names. So make sure you're subscribed so you don't miss that one. But here's the twist. Amid all the selling, Nvidia also quietly picked up two brand new AI stocks. And honestly, this flew completely under the radar because everyone was so focused on the sell-offs. No one really noticed that Nvidia was still actively hunting for new opportunities. So in today's video, I'm going to break down both of these stocks in detail. We'll talk about what these companies do, why Nvidia might have invested in them, and whether they're worth your attention or your money. I'll even share my personal take on whether I'd consider adding them to my portfolio. Spoiler alert, one of these stocks is way more promising than the other, but you'll have to stick around to find out why. Alright, let's start with the smaller of the two purchases. This one's in a company called WeRide, ticker symbol WD. Now here's the kicker. This single purchase accounted for nearly 8% of Nvidia's entire portfolio after they bought close to $25 million worth of the stock in just one quarter. So, who is WeRide, and why did Nvidia take such a big interest in them? Well, believe it or not, WeRide is a Chinese company. And they're not just any AI company, they're a leader in autonomous driving technology, but not just for robo-taxis. Sure, they're working on self-driving cars, but they're also tackling less glamorous but equally important areas like sanitation and urban services. For example, back in July, they launched the first ever unmanned sanitation project in the city of Dong'an. Forgive me if I mispronounce these cities. Then, just a month later, they rolled out a robotic sweeper service in Shantou. But here's where it gets really interesting. In August, they gained regulatory approval to start charging fares for their robo-buses in Hainan. Now, we all know analysts are projecting the robo-taxi market to be worth trillions of dollars long-term. But what about these other services, like sanitation and sweeping? These are areas that often get overlooked because they're not as flashy as self-driving cars. Yet they could be just as lucrative. Think about it. Governments love spending money, and if you can offer them cost-saving solutions like autonomous sanitation vehicles, they're probably going to jump at the chance. The best part? WeRide isn't just limited to China. They're already expanding internationally. Through partnerships with companies like Betty and Uber, they're bringing their robo-taxis to France and the United Arab Emirates. They're even entering the Singapore market with their robotic sweeper business and robo-bus services. So, with all this growth potential, is WeRide a stock I'd want to invest in alongside Nvidia? Well, here's the catch. Since Nvidia's position was disclosed, the stock price has soared by over 30% in just the past month, reaching highs of over $40 per share. More recently though, it's pulled back significantly, like many AI stocks have. Even so, it's still up over 20% since its IPO last year. But here's the real issue, their financials. And when I say issue, I mean big red flags. Their net income losses have been getting worse every year, and they're now hovering around 4 times larger than their sales. Speaking of which, their sales actually dipped last year, and I couldn't find any analyst estimates for the upcoming years. Don't get me wrong, this is still a small company with tons of growth potential, and I do expect losses to improve gradually as revenues grow. But when you're looking at a price-to-sales ratio of over 100, you'd need triple-digit revenue growth consistently for years just to justify that valuation. For comparison, other Chinese autonomous driving companies like Baidu and Neolix are trading at price-to-sales ratios of 1.7 and less than 1, respectively. Meanwhile, WeRide is sitting at over 100. That's just too rich for my blood, at least for now. That said, I think Nvidia sees this as more of a strategic partnership than a pure investment. By backing WeRide, they're gaining greater exposure to the Asian markets, which fits perfectly with their Nvidia Drive Technologies platform. Plus, every time Nvidia backs a company, its stock tends to pop. So, it's probably benefiting Nvidia in multiple ways. Alright, so that's WeRide. Now, let's move on to the second stock, which I think is much more interesting. This was the larger of the two purchases, and it's in a company called Nebius, ticker symbol NBIS. Nvidia picked up nearly $33 million worth of this stock, and it now accounts for over 10% of their portfolio. So, what does Nebius do? At its core, it's a cloud computing company with a strong focus on AI. For example, they operate a massive AI-focused data center in Finland that uses tons of Nvidia GPUs. They rent out this hardware to customers, allowing them to build, train, and run their own AI models and applications. And here's the kicker. They charge a fraction of what the bigger players like Amazon Web Services or Google Cloud charge. This is a high-demand service right now, especially with AI exploding over the past couple of years. Companies and developers are more than willing to pay for access to powerful hardware and software solutions, and Nebius is capitalizing on that trend. But wait, there's more. Nebius owns several subsidiaries that are just as promising. For example, they have a company called TUA, and again, forgive me if I mispronounce that. TUA helps customers organize, fix, and prepare their data for use in training AI models. They use a combination of AI and human experts to review and label data, which is another high-demand service thanks to the rise of generative AI. On top of that, they own Triple10, a leading online education platform that trains people in business analytics, cybersecurity, data science, quality assurance, software engineering, and more. Oh, and let's not forget WeRide, their self-driving technology and robotics subsidiary based in Texas. WeRide has already logged over 22 million miles of autonomous driving without any serious accidents, which ranks among the highest in the industry. All of these businesses combined are resulting in explosive growth for Nebius. If you look at their financials on platforms like Seeking Alpha or Yahoo Finance, you'll notice some strange numbers, like generating hundreds of billions in revenue in prior years before crashing to just $100 million last year. But here's the explanation. Nebius was spun off from Yandex, the Google of Russia, due to the Russia-Ukraine war. The owners sold all their Russian assets to local investors and separated their international businesses into this new company, which is now headquartered in Europe. When you adjust for that, the picture becomes clearer. This new company isn't profitable yet, but it's growing revenues at an alarming rate. Last year, for example, they grew sales by over 460%. They also have about $2.5 billion in cash, which should cover their losses for at least a few years while they work toward profitability. And here's the cherry on top. Thanks to contracts they already have in place, along with new ones coming down the pipeline, including partnerships with Nvidia's new Blackwell line of GPUs, they're expecting their annual revenue run rate to increase from a couple $100 million in March to as much as $1 billion by the end of this year. Now here's where things get exciting. Right now, Nebius's valuation looks expensive, with a trailing price-to-sales ratio north of 70. But if they start generating around $1 billion in revenue annually, that ratio will plummet to around 9, which is much more attractive. That's why investors are getting so excited about this stock. It's climbed almost 70% since being listed as a new company last year. Of course, like any high-growth stock, it's volatile. It's seen some sharp dips, including during the recent DeepSeek crash and the broader AI stock pullback. So, if you're thinking about jumping in, be prepared for a bumpy ride. Now here's the big question, is this a stock I'd be willing to buy? Well, I certainly find it much more attractive than WeRide, and here's why. First, Nebius has a much more diversified business model. They're not just focused on one area, they're branching out into as many adjacent markets as possible. That shows me they're ambitious and trying hard to stay competitive and grow. Second, the founder and current CEO is also the founder of Yandex, which grew to become the Google of Russia. He's seen tremendous success and I wouldn't bet against him. Finally, they have a cheaper valuation compared to WeRide, along with higher growth potential. Yes, they used to have ties to Russia, but those have now been severed. From a business standpoint, they're positioning themselves well in Europe and America. That said, I'm still not buying the stock myself, at least not yet. There are three main reasons for that. First, I already own way too many AI stocks, so I don't have the bandwidth to add another risky one that I'd need to monitor closely. Second, I can't find complete analyst coverage or projections for the future on my favorite finance websites. If I can't quickly get accurate, up-to-date information, I'm not willing to spend hours digging through their financials to make predictions myself. Finally, Nebius will face competition from some of the biggest tech giants in the world, like Amazon, Google, Microsoft, Alibaba, and others. While they do have some great differentiators and are competitive on price, it's still something to keep in mind. So, there you have it, Nvidia's two newest AI investments. Would I buy either of these stocks? Honestly, I'm leaning toward Nebius as a speculative play, but I'm holding off for now because I already have too much on my plate. What about you guys? Are any of you considering buying these stocks? Let me know in the comments, I'd love to hear your thoughts. Thanks again for stopping by, my friends. Hope you enjoyed the video. More content is coming soon. I've been renovating the studio and working on some other projects, but I'll be back with more videos very soon. Make sure you're subscribed so you don't miss anything. Thank you all for your support, and I'll catch you in the next one. Take care, everybody. Bye-bye.